better discussion to have, don't you? Well, today we're going to talk about yes, if you're watching, that was just like the safety alert. Yes, safety alert that we were told that was going to happen today. Oh my gosh, everything went off. I was worried. Realistically, we have to borrow from the bank. So before you could borrow from the bank, there's some steps that you need to take. I'm talking about this because when we got our house, our mortgage, these are the steps that we had to take as a family, as a husband and wife. So I thought, why not let's just talk about it? So let us get straight into it. So we have to talk about budgeting and affordability. It's like assess how much you can realistically borrow, like based on your salaries, expenses, and deposit. So this would be like what you can deposit, like sort of like saved up income with both spouses, your other half, your significant other, that you need to put aside to be able to afford to buy a house. Right. So it's very important that you do note that you have to deposit at least 5 to 20% of the property price. All right. And don't forget additional costs like the fees, the surveys, the stamp duty, if applicable, and the moving costs. I say stamp duty if applicable because there's some um, geographical area whereby you don't have to pay the stamp duty. All right. So, especially there's some properties if they are like below 300K at the time when we got the mortgage that you don't have to pay for stamp duty. All right. And so, when I talk about affordability, for instance, if you want to buy a house that costs £300,000, if you're looking to deposit for a house, right, then so 5% of the £300,000 was £15,000 at the time, and 10% would be £30,000. So it depends. Like you might be able to afford a £300,000 deposit, and that will be like for a three-bedroom house. I'm not talking about the area, we're just looking at the cost of the house so far. Okay, so just to bear in mind like the calculations that I'm talking about. All right, so I thought, why not let me talk about it, because I went through this when I got a house, when me and my husband got a house. So, yes, let us just, you know, talk about it and see, and to help those who want to buy a house and to see what they need to do. So, basically, if you are putting down a 10%, so that would be £30,000. If you're putting on a 20% deposit, that would be £60,000. So, yes, so we have to talk about the types of mortgages as well. We have the fixed rate mortgages, which by the monthly payments, they stay the same for an agreed period. All right. We have the variable or tracker rate, whereby the payments fluctuate depending on the interest rates. And then we have the interest only or versus the repayment mortgages. Those are the ones that you've got the mortgage and you cannot afford to pay both interest and the mortgage at the same time. So you just pay interest only so that the banks will not come after you. And then there's the repayment mortgages. So we have different pros and cons to each. So mortgage eligible. Hello, welcome back. My name is Kara, and today's topic is getting a mortgage. Okay, so we're going to talk about getting a mortgage, all right, because we need to be able to afford to get a mortgage, which is to buy a house, especially in the UK. So I believe, as we're grown women or men, as we divert into adulthood or growing up and, you know, building our families, we should talk about. getting a mortgage. It's very important. So let us get straight into it. All right. So we're going to talk about the steps that you need to know about getting a mortgage. All right. So, well, in the UK, we will have to talk about affordability and budgeting. All right. So, eligibility. So mortgage eligibility, like lenders look at your income, the credit history, the depth, the job stability, the affordability checks, your credit history. Oh my gosh, make sure your credit history is good because at the time my credit history was not good and I think it was just fair. Yes, so it's very important you keep your credit score. Keep your credit score. Make sure it's good. All right. Make sure it's good. All right. Or fair at least. Yes. So you could use something like Experian or Clear Score. You could subscribe monthly to be able to keep on track with your repayments. If it's your phone bill, is your gas bill, or if it's your electricity bill, because they keep track of everything to make sure, have you been paying like monthly? Have you been consistent? So, and also, it's very crucial that you are on electoral roll. You registered to vote every year. Make sure you're on the electoral roll, all right, so that they know that you're got a good standing with that as well. And the next step we have to talk about is house hunting considerations. When you're house hunting, especially if you're starting a family, you have to look at the location, the transport links, the schools, amenities, the resale value. Say if you want to resell in 2 years' time, how much will you be able to get as profit from the houses in that area? Do they stay the same or do they appreciate or depreciate yearly? So, yes, you have to keep that in mind. And also, do you want like a freehold or a leasehold? And do you want, what's the age of the property? Is it a new build? Some people prefer new build, some people prefer older homes older homes. So depending on what you're considering. So those are the house hunting considerations. Like when I and my husband wanted to get our property, I was very big on looking at the schools around. Is the school within walking distance? Because we moved outside London because you see when I used to live in London, the school, even though it was walking distance, at times you still have to take the car if the kids are running late. And then eventually moved to another school whereby walking was like 20 minutes walk. But because I want to lose some weight and it was hilly, and a friend of mine, she's like, no, Akara, I cannot do that with you. So yes, I had to do that. I had to push one kid in the buggy, one kid on my chest, and the other one I had to push the buggy till I could get the double buggy. It was good exercise for me, you see. And then when I moved out of London, because the school is walking distance, I still had to push the buggy and everything, but I didn't have to walk far. It's story for another time. So you have to consider all that. Is the off license closer? Like, is the library closer? Is the shopping mall or the a filling station and eateries? What else do you do? What do you do for fun? Things like that. You have to make sure you could assess all these facilities basically. So the buying process, getting a mortgage in principle, shows how much you can borrow. So they're going to do, if you're buying with your significant other, it's like going to be like your income. So say for instance, both income combined together is like £60,000, yes, and you want to borrow a mortgage. Sometimes you might want to borrow from the bank or from off the street lenders, but obviously from the bank. Some banks they multiply your salary times 3, and some banks they multiply your salary times 4. So if the mortgage is like £280,000 and they multiply your salary times 4, so that would be 240, and then that's the amount that you can borrow from the bank. So let's just say 240, yes. And then obviously you have to borrow from the government at the time. So at the time that they will be able to borrow you like 20%, and then you have to come up with the 5%. All right. So talking about the mortgage in principle, you could also use avenues that are different from that. You could use like an ISA. So both you and your partner, you could be setting aside £250 a week or £250 a month, if that's doable once you get your salary. So say your other half drops 250, you drop 250, that's £500. So, and if you do that for a year, £500 times 12, that's £6,000. As long as it's up to £4,000, you're going to get £1,000 from the government tax free. So everything will be tax free. So say you're able to do that for at least 2 to 3 years. So you're able to, save up £6,000 a year, and then 3 years that would be £18,000, and then the government will give you £1,000 each on the money. So at the end of 3 years you get £3,000 from the government. So that is £18,000 plus three, that's £21,000. So you're able to put a deposit down for your house. So that's £20,000. Bear in mind, if you wanted to buy a £400,000 property, so you'd be able to put down 10%, that's £20,000 deposit. You just have to come up with a plan and stick to it for 3 years. So that's just like an example. All right. So obviously you go and view the property, you look at the area, if it's conducive, if you can afford it long term, then you make an offer on the property. When you make an offer on the property, like say for instance they call the property £370,000, you could either offer £360,000, that means £10,000 lower than what the selling price is. So you're making an offer. So bear in mind, you can do that. Don't say, oh, it's 370, I have to put down the amount they want. No, you have to negotiate. So that's allowed. And then obviously you have to arrange for the surveyor to come and survey the house, to value the house, do a home buyer's report and stuff like that. Then you have to consider the legal conveyancing contracts. You have to have solicitors, okay, that will be able to talk directly when it comes to the negotiation. After you've done the negotiation, they will carry out the contract between both parties on your behalf. So you have legal standing when buying the property. And then you exchange contracts, you pay the deposit. So when you want to pay the deposit, you deposit the money into your solicitor's account, to the lawyer's account, and they are the ones that carry the exchange of contracts and everything with the mortgage, or obviously you might have a stockbroker that will be the middleman in between, that will be able to communicate between you and the bank. So the stockbroker would be the one that would do the communication between the bank for you, and then the lawyer would be the ones that will communicate the exchange of contracts for you between the developer or those who are selling the property and the lawyers. So they'll be able to do their own exchange of the bargain on your behalf. So basically you have to put in mind that you're paying for the lawyer's fee and you're paying for the stockbroker's fee. Okay, right. So the risk and challenges, right? So interest rates. After a year, you find out that depending on if you're doing like a 2 years fixed rate, so you have nothing to worry about for 2 years, or you're doing a 5 years fixed rate, you have nothing to worry about for 5 years. If you're doing a variable, so depending on the reports yearly, that's when your mortgage fluctuates monthly. So, some people, it's advisable for you to get the mortgage protection insurance or income protection, just in case you cannot afford to pay the mortgage for this month. Then you have income protection. And then you have to consider long-term considerations, okay? Like overpaying your mortgage. Say, for instance, they say your mortgage is £1,500 a month. So, and you have to pay it maybe on the first of every month. In order for you to pay off your mortgage quickly, you can, in the middle of the month, you can still pay like probably £500 extra. So there will not be any interest on that, and it goes to you being able to pay off your mortgage quicker instead of just sticking to the payment plan and paying as of when it's due and not paying extra. If you pay extra, that helps to reduce the interest of the mortgage and you get to pay it in a timely fashion, okay? Maybe 5 years early. So, yes, so those are the steps I thought I should let you know when it comes to buying a mortgage, okay? So, yes, I hope this helped. And until next time, if you have any questions, you could drop it in the comment section and I'll be able to answer for my next video, or right there and then I can answer in the video. So yes, I hope this helped, and until next time, bye.